The another transaction that we incur daily is the sales. We provide goods and services to the customer, and at the end either we generate income because our prices are higher than the cost, or sometimes we are receiving the royalty. There is a difference between income and royalty. We will try to see at a later stage. Now what accounting records? Accounting records the transactions. Accounting also record the events. What is the difference between transaction and events? So transactions are like sale, purchase, salary paid, electricity bill paid, etc. While events are like taking care of depreciation, amortization, bad debt, etc. So transaction is always with the third party, and because it is with the third party, there is always higher preciseness. There are documents, there is a contract, while the event is an internal matter. So there is no document which is created. It is more subjective. It is generally estimated, and there are rules how to estimate. So transactions are generally objective in nature, because we have seen that it is with the third party and it is a form of an agreement, etc. It is supported by document. In event there is no legal document as such, but it is generally recorded at the end of the day or when we close account, while the transactions are recorded, as we have seen, as it occurs immediately, and it occurs throughout the year. Primarily, the transactions create or convert equity, liability or asset. In the previous slide we have seen that we bring money as an owner to the business, we bring equity, we take loan, we create liability, we purchase assets. So these are the routine transactions which either make an impact on equity, liability or asset. On the other hand, the event occurs after transactions are occurred. Transactions is a routine affair, and events are recorded at the end of the accounting period. So it occurs after the transactions are occurred, and it is the result. It results into increase or decrease into equity or liability or asset, but it does not create any asset, as you might have noticed it. So what is the relation between transaction and payment? When we make purchase, either we pay cash or we purchase on credit. So if we purchase it on cash, then we purchase goods, goods comes into the business and cash goes out. So there are two transactions. When we purchase goods by paying cash, at the same time if we purchase on credit, what happens? We purchase goods, goods comes into the business and we create liability. Similarly, if you sell, the second kind of transaction is we sell goods and service, provide services. So similarly, like the purchase, when we sell, the goods goes out and cash comes in. Similarly, sometimes we sell on credit, then the goods goes out and we create a right to receive money. That is known as debtors. So it is shown on the balance sheet side of the asset side of the balance sheet. So as the transaction itself mentioned that these kind of accounting give you two way how accounting may be recorded. So if the transactions are recorded when actually cash comes in, the procedure or the method of accounting is known as cash method of accounting. If the transactions are recorded when liability is created or right is received, the accounting method is known as accrual or mercantile base of accounting. In India, for company it is compulsory to record on the basis of not cash method but on accrual basis. We will see at a later stage that there are some exceptions to that. Otherwise, the company act itself suggests or it make a mandate that the transactions are required to be on the basis of accrual. So transaction is required to be recorded at the earliest. So whenever you feel that the transaction is over, documents are available you to record the transaction. That is also under the Companies Act, a provision under section 209. Transactions are required